As part of the YGC currencies and organized in order to explore that. So it is in fintech. So we have Sai Dharmayohan, Executive Director at Institute in to share his knowledge and ideas with us.
Hello.
Yes, you're audible, Sai.
Yeah. So let me just share my screen, and then I can get started, right?
Yes.
So in the meantime, let me just give you some background about myself. So I was born in Colombo, and then just a second. And I did my schooling actually in India, Chennai, before actually moving to the US, where I did my undergraduate. And since graduating from university, I've been in the financial services industry, working for most of the big banks, US banks specifically, and then I have just recently moved into the fintech space. But I focus specifically on fintech is quite a wide area actually. I have the slides. I'm just trying to get them sorted out so that I can share. And just give me a minute. So can you see the PowerPoint slide now?
Yes, can see.
Okay, so great. So yeah, as I just mentioned, so I've been in the financial services space for a very long time, since graduating from college. It's 15 years. And I started off in the banks in securities trading. And over time, I've evolved more into a client services role. And now I moved into fintech, where I'm doing something similar. And I'll also touch upon why fintech actually is a different and interesting opportunity in the financial services space. So fintech is actually quite broad. If you look at what Forbes defines as fintech, it covers personal finance, Wall Street, which is basically what I work in, crypto, that's relatively new. Investment is also is a related field to Wall Street. It's basically how pension funds, asset managers invest their money, and as well as retail investors as well. That's kind of picking up significantly, especially in the US, where you have Robinhood and things like that. Lending is more, it's peer-to-peer lending, where traditionally people have had to go to the banks to borrow money. Now they can actually there are a lot of fintech applications or providers that lend money, though at a much higher interest rates. And then payments. If you look at payments is probably one of the biggest beneficiaries of fintech. Until recently, you needed a credit card or cash to pay, and now you pretty much can pay with most technology devices, like from your iPhone or watches and stuff like that, as well as making online payments. All of those have become so much easier with fintech. So that's probably the area that's seen the biggest growth. And last but not the least is real estate. I was quite surprised by it. It actually has 14% distribution in fintech. So interesting things about real estate is if you look at the UK market, it is actually very transparent and almost digital. So back in the day, you would have estate agents basically listing properties and taking 3 to 5% commission for buying and selling houses. And nowadays, the estate agent commission is roughly around 1% in the UK. So it's largely driven by technology advances in transparency in terms of buying and selling houses. It's made it so much more transparent, less need for value add from an estate agent. This is quite different. Each market is quite different. I think US is also quite relatively transparent. I'm not sure how transparent it is, but some opaque markets like Canada, where estate agents still get paid 3 to 5% for buying and selling houses. So there's a lot of wastage in terms of for people in terms of having to pay such high fees to make transactions. And fintech has definitely made changes in some countries. Regulations will play an impact in terms of how much they can actually penetrate each market. It applies to most fintechs, from personal finance, Wall Street. Crypto is not highly regulated, but still governments are starting to regulate them. Investing is also very highly regulated, lending and payments. So what I'm going to do is, since my background is more in the securities trading space, I'm going to talk about what the Wall Street, give you some background about Wall Street, because investment banking, I'm not sure how familiar you are about it. So what I'll do is I'll give you a high-level background about investment banking, what are the different units and business units, and how specifically I'll then touch upon sales and trading and investment to some extent, and how fintech has already made some significant changes in the landscape and how they can affect the future as well. So there are 5 main areas in investment banking. One is underwriting. So this is where corporates and governments raise money. So if, let's say, the government wants to build a bridge and it needs money for that, then obviously it goes to the one way to do that is basically sell bonds, raise money, and so that it can invest in certain projects. Similarly for corporates as well. So corporates can issue stock or corporates can issue bonds. Underwriting is one business. A related business is mergers and acquisitions. Here, when corporates one company wants to buy another company, like or 2 companies want to merge, example, the BA, British Airways and Iberia corporate merger, then each company will have its own M&A bank advisory that advises on how to structure it and how much to pay and how much shares each company gets. Similarly, you have corporate acquisitions. So recent one is Salesforce buying Slack. So obviously Salesforce has its own M&A bank and advisory bank, and Slack will have its own advisory bank where the banks will advise the companies on how to structure the acquisition and how the payments are made and whether you pay in stock, cash, all of that details. And the last one is the leverage buyout. So here is when a company, usually a private equity firm, takes in a lot of loan, basically leverage to basically buy another company. So when Blackstone bought Hilton, it basically was a leverage buyout where they actually borrowed money to buy another company. And banks usually provide funding or help them arrange funding for these kind of deals. The next one is, the third one is sales and trading, which is basically what I work in. So here it is mostly buying and selling of securities, stocks, bonds, foreign exchange, commodities, oil, wheat, everything. And now slowly we're moving into crypto as well, where you work as a bank's act as a facilitator between institutional clients. When I say institutional clients, it's basically asset managers, pension funds, large institutions. So banks usually don't deal directly with retail investors like you and me. If we want to buy some stock, we basically go to a small brokerage firm that could potentially send that. Let's say you want to buy Vodafone or Google, you would basically go onto a brokerage firm, log into a brokerage firm and place an order, let's say for 100 shares, and that will be routed. The brokerage firm will probably send it to a bank or some kind of a liquidity provider that will provide a price or trade it in the market. But banks mainly focus on asset managers and institutional clients. The next one is asset management. So here, banks also provide asset management service. So in addition to providing services for asset management, banks also have an asset management division. Not all banks have it, but most banks tend to have an asset management division where they actually manage the funds for pension funds or other asset managers. A more complex asset might be managed by banks. And then the last one is research. Because to facilitate sales and trading and asset management, you actually need to have in-depth research of companies in which you're investing or planning to invest in. So research is quite a significant investment for most banks. And that's also come to a lot of reason for a lot of regulatory that regulators have been trying or made some inroads into separate research from sales and trading and asset management. So there is no, banks don't get a head start ahead of the clients to which we sell research. So banking is a highly regulated industry. So obviously these have a lot of impact for companies as well as people investing in them. So regulation is quite key. There have been a lot of huge scandals in the past. So regulation is quite tight, especially in the US and Europe. In emerging markets, the enforcement of regulation is not so, it's not very strong. So you do tend to have concerns in terms of investing over there, transparency and things like that. Now, going into the sales and trading business, so what I want to do is give you an overview of the business before we actually go into the technology aspect of it. So it's mainly divided into three parts. You have the front office, which is basically what I would call the revenue generating unit of the business of sales and trading. So here, all the strategy of development, marketing, sales, client engagement, product development, pricing, trading, deal negotiation, all of that comes under as front office. And then you have middle office. What you call middle office is here risk management, compliance, customer onboarding. So this is considered the middle office of let's say a bank. And the back office is basically human resources, IT infrastructure. So IT is everywhere now. So when I say IT infrastructure, it's basically the networks, the PCs, the phone infrastructure, as well as the servers and the data centers and things like that. And data processing, accounting, clearing, and settlement. So all of this is considered back office. The reason this is quite important is because sales and trading has actually had a lot of technology investment in the past. So securities trading was one of the early adopters of digital transformation in the 1960s. So what I mean by this is even around 60 years ago, you could actually place an electronic order through a computer to buy and sell stocks. So that's quite unique because not many industries were adapted the use of technology back then. And investment banks continued to be a technological innovation, leading technological innovation in the 80s and 90s. So most banks or some of the major banks actually had their own programming languages. So if you look at Morgan Stanley, they had something called A+, which eventually became KDB. Right now, it's very widely used in the financial industry, and it's also being used in other industries. It's basically a flat file time series database, but it emerged out of a bank in Morgan Stanley. And then Goldman Sachs also has their own programming language, Slang. So again, this was developed in the 90s, mainly to meet the needs. They didn't feel the existing languages, programming languages at that time met the needs of the financial services industry. So in terms of processing very large time series data and being able to roll things out quickly. So they developed their own programming languages and were kind of innovators in that space. But what happened over time is, let's say in the around 2000, mid 2000, between 2005 2010, regulation and when we had the issues with the financial crash in 2008, there was a huge obviously banks didn't have a good PR in that around that time. So regulators obviously started focusing a lot more into what the banks do and trying to place more onerous regulations, financial capital requirements on the banks. So this slowly led to the decrease in investment in technology, and it has limited it, and the focus mainly has been in terms of keeping up with the regulation and making sure banks don't get a bad PR again. So, but obviously that hasn't always happened. Banks have had issues even in the last decade, but for most part, a lot of investment has actually gone into the regulation aspect of it. And that itself is a separate area called RegTech, where there are vendors who actually provide technology that banks can now use to kind of be better, smarter in terms of adhering to the regulations. So that's a very growing field, RegTech. I'm not going to cover that in detail, but I'll probably just give you and speak about it when I can. So what that's happened is over the last 10 to 12 years, banks haven't really adapted the latest technology in terms of they haven't embraced open source code and migration to the cloud. So most of the technology banks have are probably around 15 years old, with large servers and backend operations, which are not the most efficient. And also banks value their IPs quite a lot. So moving to the open source was kind of looked down upon until recently. So slowly they're beginning to embrace the move to the open source and cloud. So what's been driving that recent change is basically the squeeze in profitability and competition from fintech. So this is the next stage of transformation, which is now happening, is basically banks are moving more, beginning to embrace open source, move to the cloud and adapt to the cloud and compete with some of the more nimble fintech companies in the space. So how they're doing that is obviously they need to focus on regulation. So what they came with an innovative approach is basically had accelerators or fintech accelerators within each bank. So for example, Citigroup has an accelerator in Belfast and in Tel Aviv, Israel. So where they just focus on innovation. You have various teams, they come up with ideas and focus on innovation. And then when they think it's ready, they basically incorporate that into the bank's business. So most banks actually now have that accelerators and funding for innovation as a separate standalone unit, rather than being within the bank and being subject to funding cuts and things like that. So it is an interesting development in the space. So now going into a little bit more detail about what the sales and trading actually is let's say you have a lot of your pension contribution that you put basically goes into an investment manager. And the investment manager basically decides how they need to invest that money. So typically, traditionally, let's say 20 years ago, what they would do is they would basically read through all the research reports that the bank's research business generates, and then decide, okay, which company I want to invest in. And then they would call the bank and say, okay, I want to buy X shares of this company. And then the bank would basically give them a price and usually a reasonable markup in terms of what the market is trading. And then the portfolio manager will basically buy it And if they need to sell sell a stock, then they would go through a similar process for selling it. But what's happened over the time is, over the last 20 years especially, is the whole thing has basically become digital. Electronification of investment and trading, that's how we call it. So electronification of investment is basically the portfolio construction process. So in terms of analysis of stocks, the risk management, and deciding which stocks to invest in and how much to invest in each stock is all basically, now you have software that basically helps with this process. You have software that can analyze research reports, not just research reports, but also social media posts and Instagrams and Facebook and all kind of social media to basically determine which stock to buy based on sentiment. And then you have tools that basically help with risk management in terms of how to diversify. You don't want too much of bank stocks. Let's say if there's another financial crash, then obviously your portfolio will lose a lot of value. Or if doesn't, so you need to be well diversified. That's called risk management. And then we have pre-trade analytics. That's basically what it means is telling how much it's actually going to cost you to buy that much amount of stock. Let's say if you want to buy $100 million worth of Tesla, how much would it actually cost? It's not going to be $100 million, but for $100 million of stock, you'd probably end up paying a little bit more in terms of fees, because if the market knows that there's a large buyer, then obviously they are going to increase the price. So all of that is taken into account in terms of pre-trade analytics. So you need to take all of that into account when you construct your portfolio. So once you construct your portfolio, then you need to execute it. So basically you need to go buy some stock, or then you might have some stock which you need to sell. So you don't want that stock in your portfolio, so you need to sell. You basically have buy and sell. So traditionally you would pick up the phone, call your relationship manager at the bank and say, okay, I want to buy X shares of this, XYZ, and then I want to sell X amount of shares in another company or a few lists of companies. But all of that is now electronic. So you basically create a list and you basically send an electronic order. You put it into an order management and you send it to the broker and say, okay, this is what I need to buy. I need to buy X shares of company ABC and sell Y shares of another company or a list of companies. And then what the bank actually does is it finds the most efficient way to actually buy and sell that amount of shares. So just to give you an idea of how much banks deal, typically in London, a reasonable investment bank would basically do around $5 to $6 billion worth of execution every single day. So all of this is done fully electronically without any involvement for human being. So that's where the execution is. It's a quite complex process, the execution, and I think I also have a slide that will later show the execution stack. But what that involves is basically finding out, it's something called algorithmic trading. So you take an order and then you find out how best to trade it. And then sometimes you might actually do principal facilitation. So banks, through their own money, they might actually buy it from the client. And then you also have surveillance. Surveillance is quite new. So this has grown especially on the back of a lot of front running, where let's say a client wants to buy 1 million shares of Tesla. Somebody in the bank notices that a client is actually buying Tesla, and they actually call their relative and say, you know what, you should buy Tesla now because there's another buyer, a huge buyer. Then you can, if you buy it now in the evening, you can sell it back to him. So those kind of abuse and front running used to happen quite a bit in this industry, at least in the late 90s and early 2000s. And that's why you have surveillance, where now you need to have technology to make sure any sales trader or anybody who actually has information about clients can't actually do that kind of front running. So there's a lot of technology investment in that space. Your phones are monitored, as well as you're not allowed to use phones inside the bar, while you're working and things like that. So it's a lot of technology investment that again comes under reg tech. So there are vendors who actually provide surveillance software that banks can actually purchase and use on PCs and phones. So once the order has been placed and executed, then you have to clear and settle. So your clearing and settlement is basically telling it's all electronic. So nobody gets a paper saying you own X shares or Y shares. It's all centralized. So the central authority needs to be notified that the buyer, the seller has sold the stock, X amount of stock, and then the buyer has actually bought it. And then they all get notified that it's actually been accepted. And then you have performance attribution. So what we call as transaction cost analysis and market impact, which is basically driven out of market impact models. So when, let's say, the portfolio manager wanted to buy $100 million worth of Tesla, but it ended up costing $102 million. So basically, it's basically a 2% markup he ended up paying. So it's usually not as big. The markup usually tends to be around 0.01%. So it's usually considered in around basis points. So that's basically what it costs for the portfolio manager to buy that stock. And that's something that needs to be accounted when they want to sell it as well, because every time they sell it, they also incur that cost. As well as finding out if they actually did that better, is there a better way to actually trade it? Did they spook the market? Did someone tell the market that this portfolio manager is actually buying a large amount of shares? So the market actually price moved before they could actually buy it. So all of that is called performance attribution and transaction cost analysis. Here again, there are a lot of vendors who actually provide these tools. So they're quite sophisticated, and there is still a lot of room for improvement in the space, so which I will cover in a bit. So first I want to go over the algorithmic trading, what it actually means. So until, let's say, 80s and 90s, if a portfolio manager wanted to buy a stock, he would call the relationship manager. The manager would basically, let's say, enter it in the computer and then basically call someone on the exchange and say, okay, my client wants to buy X shares of a list of companies and wants to sell another amount of, let's say, shares in another list of companies. So it was quite an intensive process where it was very manual, prone to abuse. Obviously, people are having information about somebody else, which they can abuse. And obviously, it was quite inefficient, expensive. And that's when the algorithmic trading came about as basically an efficient way to actually buy and sell stocks without inefficiencies in the market. So you want to take away all the inefficiencies, the market impact, the front running, all of that stuff. So they were built on the back of, to be able to do that, you actually need you need to have data in electronic form. So everything that's happening in the stock market needs to be available as data, as well as for, let's say, for you to make informed decisions of when to buy, what's the right price to buy. You need to have historic market data, as well as nowadays, people use sentiment analysis, like in terms of live Twitter feeds to kind of figure out what's happening in these companies. Have they made any announcements? If they made any announcement, is it positive? Is it a good announcement? Is it a bad announcement? If it is good, then you're a buyer, then you want to buy it soon. Whereas if it is a bad announcement and you're a buyer, you probably want to buy it more slowly so that the price can come down. So all of that data, there's a lot of data processing that needs to be happening in the trading system. And then all of this data goes into models. So you have market impact models. You need to understand the market structure where you're working. So the European market structure is very different from the US market structure due to regulations. So the algorithmic trading system needs to know about each market, how each market is structured, what are the regulations, what are the restrictions in algorithmic trading. Then obviously you use that with statistical models. Right now, people use decision trees, reinforcement learning, graph networks. And obviously there's always innovation in terms of finding newer ways to kind of execute. And improve your efficiency of trading. So that's the models. So once you have the models, then you actually need to send that order out to the market. So once the model has decided, okay, though I want to buy 1 million shares of this firm, right now at this time, I want to only buy 1,000. And so then it basically creates an order for 1,000 that needs to go out to the market electronically and to the exchange. So again, there are several exchanges where you can buy. So what we have a technology that determines where do you actually go to buy it. And once execution is done, then there's a feedback loop, because then new market data is generated. So you you determine how the algorithmic system is actually doing versus your objective function, your performance benchmarks that your clients have provided, and then you use that again as input, data input to the model. And then so it's a feedback loop that basically until you fully bought and sold all the shares the client has asked you to do. So this kind of process usually trades around 5 to 6 billion US dollars every single day at each at some of the big banks. So it's quite a lot of automation and risk that's actually happening here. And if you look at 2010, there was something called a flash crash when one of these algorithmic trading system basically went out of control basically, and ended up moving the market too much. And that brought in a new set of regulations to kind of oversight on the algorithmic trading systems, limits on what it can do and what algorithmic trading system shouldn't do, and so that it doesn't affect the market stability. So again, there was a lot of innovation in the space until around that time. And then once the regulations came in, innovations kind of stalled, and it almost kind of took a step back to kind of put limits on what the algorithms can do. A lot of machine learning research that was happening had to be pulled back simply because the regulators weren't comfortable with machine learning at that time. Because it was like a black box. If we couldn't predictably say what it would do, regulators didn't want them trading in the market and affecting the stability. So there was some level of setback in the space about a decade ago, but slowly people are gaining comfort and things are starting to move back again in the right direction in terms of innovation. So this is something I got from, I have the source on the bottom right corner. So this website does have a good detailed description of the ecosystem. So this is basically what it takes to kind of have an algorithmic trading system. And this, I think, is they've also identified this as pieces of software that can be in AWS. So these are things that are now in the cloud. Typically, most banks don't have it in the cloud. So now, as banks are moving and embracing cloud, they basically are moving certain pieces of information, certain pieces of the infrastructure into the cloud. So like market data. And this is the algorithmic engine, which I described. As you can see, it's a very small piece in the entire puzzle. So here, what it means is basically client is sending an order, and then order goes into a cloud system, which basically sends it into the internal trading system. And that basically uses the algo engine to kind of determine how to trade. The algo engine uses market data and then makes a decision, and then its decision is sent to the venue gateway, which basically goes back out of the AOS into the firm infrastructure, and then it goes into the exchanges, various different types of exchanges to actually do the trade. And once they come back, then you go down to the post-trade where you actually report to the regulator, not regulator, FINRA is basically in the US, where you report that you've actually made a trade. Somebody X, client X has bought a certain amount of shares and client Y has sold a certain amount of shares. So all of that happens in the electronic infrastructure at the bottom. So this is an entire ecosystem that is needed to actually do just the electronic trading and notifying the client that they've actually bought and sold something. And there's been a lot of innovation in the space. This is considered front office infrastructure. And there has, in the early 2000s, there was a lot of investment. Then the late 2000s, around 2010, a lot of investment on the regulatory aspect, and now more slowly, this infrastructure is being migrated to use more modern technologies. So what are the challenges and opportunities over here? So challenges that we've already touched upon. It has very high regulatory costs. So the regulators in the US and Europe have made it extremely hard for a newcomer or someone to basically just spin up a computer, write a piece of code, connect to the exchange, and basically buy and sell stocks. So that's made hard for fintech to actually compete in the space. There are very few fintechs who can actually compete. And the fintechs that are here in the space also need some kind of backing from banks, without which you don't have the capital to actually, if something goes wrong, if your algorithm goes wrong, you could end up being stuck for like hundreds of millions of dollars. So you need to have that level of capital put into the regulator as well as to the exchanges to be able to trade. So there needs to be, it is quite a capital intensive business. So what are the implications of that? So when you have, let's say, for every bank, you have to put 100, 200 million into a regulator and have it stuck there, that's money that's actually not making any return. So it's just sitting there that you can't actually invest. So banks need to be sure that actually that is actually worthwhile. So if you're going to have $100 million sitting at a regulator without any return, then it should be of good use. Like that, you need to be able to get good revenue out of for the business that it is supporting. So that's what that makes it harder, because now the business needs to be a lot more profitable so that you can make up for the lost revenue from capital that's sitting somewhere that you can't actually use. And as well as compliance. So this is prevention of front running, market abuse. So market abuse is basically impacting the market. Front running is basically somebody taking information about a client and then using that to make money themselves. So there's a huge cost to actually comply with these capital and compliance requirements. And there's structural costs as well. So what you've seen is banks have invested a lot in the front office aspect, like the trading aspect of it. So they have good trading infrastructure, good mathematical models, scientific models. Data science is being quite intensively used in terms of the trading aspect. But what's lacking is the middle and back office. So this is basically, when we go to the previous slide, it's this bottom part of it actually has very little infrastructure, very little investment recently. So there are areas in this process which are extremely manual. So middle and back office has a lot of manual labor in it. So most banks will have their middle and back office for, let's say, supporting the UK, European markets. Let's say some banks have their middle and back office in Birmingham, Belfast, Berlin, that are considered as low cost areas where you can actually have lots of manpower to kind of do this. But obviously that's not scalable. And it actually is also, what we've seen is there is revenue compression. When I say, as technology becomes more and more advanced and technology is more democratized, you have smaller firms that are slowly creeping in and offering services for cheaper. So banks have to reduce their profit margins, which basically means they need to be a lot more efficient in terms of overhead. So which means a lot of the middle and back office now have been identified as areas where cost reduction is essential rather than an option. And the way they are going about it is using vendors. So this opening opportunities for vendors to kind of step in and provide technology and services that banks can actually use. So why is it still very attractive to be in the financial services industry? It's simply because it's expected to grow so much. Right now, most of the market that's actually generating money is basically the US, Europe to a smaller extent, and Hong Kong. Even China hasn't actually scratched the surface, and India is nowhere near it. So the revenue potential in terms of expanding this infrastructure globally and being able to trade globally is around roughly 3 times, is expected to grow around 3 times in the next 15 years. But obviously that also means investment. You need to invest in each of these different markets. You need to understand the regulations of these markets. You need to understand the cost overhead of these markets. And moving into emerging markets is not very straightforward, because the same things that I mentioned, like front running, market abuse, they're quite widespread in less developed markets. And it's a huge risk for global banks being exposed to that, because if one of their employees in a developing market is actually found to have front run a client's order, then it's a huge PR disaster for global banks, especially after what they've been through. So they tend to use third-party vendors in markets where there are higher risk. So higher risk of these, or where there is no strong enforcement of regulation, there is opportunities for technology providers or local providers, what they call brokerages, to kind of provide services to the big banks. And as these markets mature, they're also becoming more homogeneous. Like, let's say 10 years ago, the Hong Kong market was very different to how very different to how Europe and the US was regulated, but now they're quite similar, including Singapore. So they've all, as they mature, you can have basically a single system or single process that you can deploy in these different markets, and basically then it's just servicing the clients. And why is there more and more money to invest? Because there's also the rise of middle class globally. So as the middle class increases, people have more money to invest. They're contributing more into their pensions. They're contributing into, let's say, investment portfolios or investment managers where they think they can get more return. So there is a lot more money to invest, especially in these times where interest rates in developed, like in UK, the interest rate is almost 0.1%. So there is no point keeping that money in the bank. You probably are better off trying to invest it somewhere where you can get good returns. Traditionally, people go into real estate, but now obviously real estate has great. So investing in equities and cryptocurrency, as well as startups. So people are, as the middle class grows, they have more money to actually invest. So that's definitely an opportunity. And then disruptive innovation. Obviously, as we said, banks are not only looking to build technology themselves, but also looking for vendors who can actually provide innovative solutions to the problems they have. And so what I'll do is, in this slide, I'll just go through some of the areas where I think there's most potential for innovation, like providing solutions in the near term. So this chart on the right is basically something by Ernst & Young about capital markets landscape. What are the technologies that actually can have the greatest impact in the financial services industry? So some of the big ones are advanced analytics, artificial intelligence. Artificial intelligence is more on the regulatory side. So this is RegTech. Again, RegTech, if you're interested in RegTech, artificial intelligence to identify erroneous trades, market abuse, front running, finding efficient ways to identify that. So that's actually very popular. It's gaining in terms of the RegTech space. But it's not an easy space to actually get into, because you need to understand the market. You actually need to understand the regulations. So you need, to some extent, you almost need to have like a legal background to understand the rules, interpret it, and then build the technology to actually solve it. So let's say if you want to look at what are the opportunities in that space in Sri Lanka, you would basically want to look at the Colombo Stock Exchange, look at the regulatory manual, and see basically read through that, understand that fully, and then speak to compliance regulators to see where the opportunities are, and then develop the technologies to kind of solve it. But once you solve it in one space, as the markets converge and become more homogeneous, it's an opportunity to basically sell that to other markets. So there's definitely an opportunity in RegTech, but it is not as simple as basically building software and selling it. But where you can actually add values is analytics. So advanced analytics is something where there's always need to be much smarter in terms of how you trade, how you invest. So one of the areas is sentiment analysis. So sentiment analysis is basically reading through live news that's coming in from Instagram or any other APIs, and basically figuring out how much of a positive or negative news it is for a particular company. So there are a lot of research projects, academics who are actually working on it in terms of sentiment analysis. And that again ties in with predictive analysis. Here you're basically trying to take in the sentiment analysis you've done or any other kind of mathematical or statistical model you might have, and then say predict in terms of how is the stock price going to move in the next 5 minutes, 10 minutes, 30 minutes, and or even 2-3 hours. And these are quite crucial in terms of being able to determine how you price your stock. So that's how there are currently a lot of liquidity providers in the market. So what they do is they have very strong predictive analytics in terms of short-term models that can predict the stock price in between the next 30 seconds to, let's say, 2 hours. And they use these predictive models to kind of provide liquidity to both clients and the banks as well. So that's another area where there's been a lot of progress, but I think areas there can be a lot more progress, especially in emerging markets, because predictive analytics works quite well in the US and Europe. But once you start going into emerging markets like Middle East, even Asia Pacific, then these predictive analytics is not really very strong. People don't understand the marketplace, the complexity of it. So they haven't really invested time and effort into those markets. So that's definitely an opportunity where for those fringe markets, you can actually develop price forecasting models. And it's not too difficult because it's usually you can use available market data that should be available for free or for relatively low cost. You can basically ask the exchange to provide you a flat file with, let's say, 2 years worth of market data, or start with even a few months worth of market data, do some analysis and write some models, test it out, and then you sell those. Once you have a product, then you can basically sell it to either banks or even asset managers. And then understanding the cost of trading. Again, this is about how much is it actually costing you to trade in these different markets. So it takes, it involves a good deal understanding of the market structure, as well as being able to visualize what you actually see. So it requires data visualization and being able to tell a story of what's happening in terms of your cost of trading. This requires both transaction cost models, so price impact cost models, which basically specify how much is the theoretical expected impact and how much is your realized impact. So at a very high level, it tells you, are you doing better than expectation, or you actually need to do a better job in how you actually execute your investment strategy. And then in the middle office side, you have data visualization for compliance and regulatory requirements. So this is basically RegTech, which I basically touched upon. So here, data visualization as well as artificial intelligence are going to be quite key in terms of driving this RegTech. It's not a revenue generating field, so banks don't tend to spend a lot of time and money on it. They tend to just use vendor products because there is no IP in it. It's just like a checkbox exercise that banks need to do so that the regulator is happy with them. So since it's not revenue generating, there isn't a lot of investment in terms of proprietary investment in it. So again, here understanding the local regulations and providing software that banks can actually use to ensure they are compliant with the local regulations of different countries and markets is definitely an opportunity. And then you have the digital transformation of the business. So what here I mean is the trading aspect of it has actually been quite efficient in terms of being digital, being electronification of the trading infrastructure. But client engagement is actually not very intelligent or very sophisticated. So you still have salespeople using Salesforce, which is actually a more generic sales tool rather than something specifically for the financial services industry. So banks, as well as there are now software companies that are actually focusing on basically Salesforce equivalent for the sales and trading business, where you can actually analyze the different stocks. What kind of stocks is a client actually buying, and what are the related stocks? Let's say you could potentially sell to the particular client, to that particular client. If the client bought a stock a few months ago and the price has actually gone up, then basically maybe you just make a call to the client and say, hey, do you actually want to get out of that position? You've actually made a good amount of money, and our research suggests that that stock might not be moving up anymore. So it might be a good time for you to get out of that position. So those kind of intelligent client engagement driven by data, as well as transaction history, is actually quite key. And there's a lot of investment both internally as well as from vendors in terms of the product development in the space. And back office is basically client profitability. So this is because your clients tend to trade a lot in hundreds of millions of dollars in each trade. So how much are you actually making? Because if you're charging them 0.01% in terms of commission, does that cover your cost? In terms of resources they're utilizing, do they take up a lot of research and hand-holding to actually get that revenue? So that's the client P&L is something that banks haven't really focused on lately, largely, simply because the margins were quite large. But as the margins tighten in this business, each client needs to be analyzed for the profitability and making sure banks don't put in more resources into that particular client than they should or than they're able to actually make. So that is actually quite key. And here again, AI and data-driven software is being developed by a few companies, and it's not totally effective, but there is progress in the space in terms of understanding client profitability. So this is a very high level of high-level overview of the financial services or sales and trading and the fintech association in this particular space. Obviously, you can go into a lot more details in each of these components, like a RegTech itself is can be a separate session. So, but I hope this is giving you a high-level overview, and then that you can actually use to kind of do your research and figure out if there is anything that's of interest to you. Then, yeah, you can kind of research and investigate more into it.
Thank you for the presentation. So if you have any questions, please post it in the yes. So that I think to find out doing great present about the opportunities available in the fintech. Thank you so much.
Thank you.
Thank you for